Banks have recently been criticised for failing to pass on the full RBA rate cut. Let's have a look at whether that criticism is justified and whether there might be good reasons for banks failing to pass on the full cut. Now, with some basic background here, the RBA recently cut rates by 25 basis points, taking the official rate to an all-time low. However, banks only passed on 10 to 15 basis points of that cut. This has led to criticism of these banks on grounds that they might be profiteering. This criticism has come from many sources, including from politicians. Now, to understand whether this criticism is justified, we need to look at how banks operate in this context. Now, a bank is basically an intermediary. It sits between depositors and other sources of capital and people who are borrowing. It needs to pay money to depositors in return for getting that capital, and then it receives money from borrowers such as homeowners or people who are borrowing for cars or myriad other personal reasons. In this context, the bank's profit margin is basically the difference between what they're paying to depositors and what they're getting back from borrowers. So to understand if banks are profiteering, we need to look at that margin. Now, to do this, we need to look at a couple of things. Firstly, are banks' profit margins historically skyrocketing such that bank profitability has increased significantly? Secondly, we need to look at, does this particular effect of not passing on the full rate cut lead to significantly increased bank profits? So to look at that first one, basically bank profit margins and general profit metrics for banks haven't historically been increasing that much over the past couple of years. And according to some metrics, such as ROE, banks' profitability hasn't increased at all or has been very stagnant over the past few years, suggesting that banks over the past little while haven't been significantly profiteering. That might be due to various things that include increased cost of capital from overseas, due to, for example, the actions of the Fed in the United States, or could include factors such as the Royal Commission, which has recently crunched banks' profit margins. Admittedly, the Royal Commission has mainly affected other lines of business for banks, but nevertheless, at a bank level, it's reduced profitability. So that's the first thing we need to consider here. Banks' profit margins haven't been shooting up over the past couple of years in general terms. The next thing we need to consider, of course, is would failing to pass on the full rate cut increase bank profitability? Now, this is a slightly complex answer. The reason for that is when banks are getting money that they can then lend out, the source of that capital is a couple of sources. Firstly, you've got general depositors, such as people in Australia putting their money into a bank account. Secondly, you have overseas sources. That might include other overseas banks, or could include various other overseas sources of capital. So those are the two major sources of capital that banks will use to then lend money out to borrowers. Now, the RBA rate cut doesn't directly affect the cost of that capital. For example, the RBA rate cut does not immediately lead to a cut in the cost of deposits. It also doesn't immediately lead, and would not in general terms lead, to a cut in the cost of overseas sources of capital. So for that cost to decrease, banks will need to decrease the rate that they're paying to depositors. However, that's quite tricky to do because that rate is already incredibly low. So banks are really cut and really limited in the amount to which they can pass on that rate cut to depositors. This means that for banks to pass on the rate cut to borrowers, it would be quite difficult for them to pass on that cut to depositors, i.e. the cost of the capital isn't going to go down at the same rate as the profits they would get and the revenue they get from their borrowing. That basically means if the banks were to pass on the full rate cut to borrowers, they would need to pass on the full rate cut to depositors to make up for the loss in revenue they'd otherwise get. That's politically untenable because banks can't really pass on a 25 basis point cut to depositors because deposit rates are already quite low. So it would be very difficult for banks to do this. As a result, banks would only be able to pass on a portion of the rate cut. The reason for this is when they're passing on the rate cut, they need to pass it on to borrowers and to depositors. So if they're going to pass on a 25 basis point cut to borrowers, they would also need to cut deposit rates by 25 basis points. Alternatively, if they're only passing on 10 basis points cuts to borrowers, they would only cut the deposit rate by around 10 basis points or thereabouts in order to maintain their profit margin. So as a result, banks' profit margins are going to remain relatively stable if they pass on the rate cut to both depositors and to borrowers. However, if they had to pass on the full rate cut, it would be quite difficult for them to pass on that full cut to depositors without significant backlash. As a result, banks only pass on a portion of the rate cut to borrowers because they can only pass on a portion of the rate cut to depositors and still keep their profit margins at the same level as they were before. If they were to do otherwise, their profit margins would actually shrink. So basically what banks are trying to do here is maintain their profit margin rather than necessarily increase it when they're passing on the same rate cut to both depositors and to borrowers. So for that reason, some of the criticism that banks are profiteering might be a little bit over the top, because banks in broad terms are maintaining a similar profit margin to what they had before by keeping a symmetrical cut to both depositors and to borrowers. Furthermore, the cost of the capital from overseas, to which banks are somewhat reliant, is in no way affected by the RBA rate cut, and sometimes actually increases. So the RBA rate cut certainly does not in any way affect that cost of overseas capital. So when we're looking at that cost of overseas capital, if that remains constant, but their revenue declines by passing on the rate cut to borrowers, that would actually decrease bank profitability, even if banks only pass on a portion of the rate cut. So for this reason, some of the criticism that banks are profiteering might be a little bit overstated. And while it would be ideal if banks passed on the full rate cut to borrowers, that is actually quite difficult for banks to do while maintaining their same level of profitability. Maintaining profitability, of course, is important. It's important for a few reasons, but primarily it's important because a lot of investors, by virtue of their super funds or various other holdings, own shares in banks, so they have a vested interest in keeping bank share prices at least relatively stable and keeping banks' dividends relatively stable in order to prop up their retirement funds. So in broad terms, it is helpful in general for banks to have a relatively stable share price because that helps retirees. So I hope this gives you a bit of an idea about why banks might not be profiteering in this instance, and why some of the criticism might be a little bit overstated, and why banks might have a good reason for not passing on the full extent of the RBA's rate cut. So thanks so much for tuning in. I hope the video has been informative to you. If it has, it would be great if you click the like and subscribe buttons, and I hope to see you next time. Bye.